Pranav Gundlapalle. He's a senior research analyst at Bernstein who's joining us on the show right now. Pranav, good morning. Thanks for taking the time out. Let's start with your view on HDFC Bank. Well, more pros and cons this time around.
Yeah, so I think going into the earnings over the weekend, I think what was known was the weak loan growth. I think we got that from the headline numbers, but all the incremental information I would say was largely positive. I think NIM staying flat despite the reduction in LDR, and borrowings not declining a lot was a positive. OPEX growth moderated again, and also fee income growth I think came back after a pretty weak last quarter. And most important was that we didn't see any increase in credit costs or a pickup in slippages, something that we have seen for some of its peers as well. So I think overall a positive set of numbers, not a lot of surprises. And that whole ROA improvement thesis seems to be well in place, and balance sheet normalization ROA improvement thesis seems to be intact. So say a good quarter on an absolute, and more importantly on a relative basis rather than an absolute basis.
It's also Samina joining in, and it's a complaint. You've taken extremely long to come back and talk to us, so you should be talking to us more often. You called out the recovery on HDFC Bank maybe a quarter back, right? And it seems like things are falling in place for the bank. What do you think is not working for HDFC Bank, or what needs to work for it to completely do the 360 change?
See, I think there is a normalization which is underway, and it will take time. I think that LDR normalization seems to be a top priority for the management, and therefore weak growth is known. What will help the bank, I think, is an environment where the credit growth slows, deposit growth picks up, and if you throw in some asset quality deterioration, then yes, I mean, that will make it the perfect environment for the stock to really outperform. But from an operating metrics perspective, I think most of the requirements are largely in place. I think it's only a matter of time that they fix the balance sheet, which is get their LDR below 90%. And from there on, I think they should see their growth on par with peers. And until then, what we look at is their deposit growth. As long as that growth delta versus peers of the system is intact, I think the whole thesis remains quite intact.
How glad are you that the provisioning has been kept at 2,700? I mean, while the industry struggles with it, interestingly, HDFC doesn't seem to have too much trouble around that.
I think that hasn't been a big surprise because they have hardly grown in the last 4 years in the non-mortgage retail segment. So if you look at peers, most have seen, the largest bank in the country has seen about 25% growth in the non-mortgage retail segments, whereas HDFC has seen only about 10% growth over the last 4 years CAGR. And that means that if there is any deterioration in asset quality, they would be the least impacted. So the asset quality shining is not a big surprise. I think the quality deteriorating for peers is where the relative difference starts to kick in.
1684. Would you still go long on HDFC Bank? What is your target price on the bank in the near to medium term?
Yeah, so we have a 12-month target price of 2,100, and we think them showing a few more quarters of that normalization of balance sheet should drive the upside there. And in terms of risk from here, I think a sharp slowdown in deposit growth is really the big risk that the bank faces. Not just for itself, but for the system-wide, a slowdown in deposit growth, to me, is the biggest risk that the bank currently faces.
All right. Pranav, let's move on and talk about Kotak Bank as well. We were expecting pressure, and it does seem like the earnings have not been up to the mark. But what is your analysis here?
See, I think this was a quarter where the bank part of the Kotak entity disappointed. This was the first full quarter post the embargo, so I think that pressure was very visible. They did manage to deliver on growth. The overall loan and deposit growth was quite strong at 15%, but it came at the expense of margins. So the NIM continued to decline almost 11 basis points Q on Q, driven largely by a forced shift towards the secured businesses. And I think the bigger concern for us is the increase in slippages. Now, Kotak's, the reason why investors have loved Kotak is their phenomenal asset quality trends over the last 10, 15 years. So any further deterioration on the asset quality, I think, would be a big negative. So far, I think it can still be categorized as normalization, but anything further from here, I think, would put that conservative premium at risk for Kotak.
Just taking a cue from what you said, the credit slippages is become a problem for Kotak. Do you feel like this is an early indicator of what's to come for the whole sector? Because Kotak is probably one of the best, or rather best in terms of being risk-focused in that sense.
Yes, I think that's what they've been, known for in the past. The only caveat here is that some of the businesses where they're seeing stressed credit cards, for instance, are areas where they've grown recently. So it would be probably not fair to extrapolate their past credit underwriting outcomes into the newer segments. And there is also a certain seasoning of segments that always needs to happen, or portfolios that needs to happen. So yes, there does seem to be a sector-wide stress in the unsecured loans book, unsecured loan segments, and Kotak has, at least if this quarter is any indication, is not immune to it. Now, whether how they fare versus the broader sector, I think we'll have to wait for the next weekend to see. I think once ICICI and SBI come out with their numbers, I think then it becomes much clearer as to how they fare versus the broader market.
What can we expect in terms of resolution? Some timelines the management may have indicated when it comes to, its credit cards department, the challenges there?
I don't think there's any timeline that management has put forth. I think they are still working in terms of making the necessary changes, the investments required. They have an auditor on board to ensure they are on the right path. But I think a wholesale tech changes of the nature that RBI seem to highlight, I think will take some time. And I think the appetite for the higher yielding products does seem to be there, because they've just bought Stan Chart's portfolio last week. So once it resumes, I think we will see them come back into the PL and credit card segment. That might help the margins front, but the timing seems to be quite uncertain at this point.
Again, Pranav, your rating on Kotak Mahindra Bank, as well as the fair value that you're putting it at this point?
So yeah, we have a market perform on Kotak. We have a target price of 17.50. Now, unless we see a big pickup in their deposit accretion, especially the low-cost deposit accretion, we think that growth premium that they've had in the past is at risk. Therefore, we're not too bullish on the bank until the RBI embargo lifts and we see a clear improvement in their liability franchise.
All right, Pranav, we'll leave it at that. Thank you so much for joining us and giving us your perspective on those two very large private sector banks. Of course, we'll be watching out for the reactions coming in this morning after its earnings.